In business, success can take years to build, but sometimes only one bad decision can destroy everything today. We're breaking down how a company once worth billions of dollars completely collapsed. This wasn't because of fierce competition, nor was it due to a sudden recession. It was because of a single, catastrophic financial mistake. This is the story of how a seemingly smart move became a fatal one. The company started small, fueled by a smart idea, strong leadership, and an incredible drive for rapid growth from the very beginning. They were on a trajectory to the top. Investors saw the potential and poured in money. Revenue didn't just grow, it exploded year after year. The team was dedicated, and the employees truly believed their future was secure within the company walls, on paper, and in every meeting. Everything looked absolutely perfect. They were the textbook definition of a modern success story. Then came the decision, a pivotal moment that would alter their destiny forever. The management team decided to borrow heavily to expand even faster. At the time, it seemed like a no-brainer. Loans were cheap, interest rates were at historic lows, and the market looked completely unstoppable. They saw an opportunity to conquer their industry by scaling aggressively. So, they took on massive amounts of debt, operating under the firm belief that future profits would easily cover the repayments. This single choice, made in a boardroom filled with confidence, is where everything began to change at first. No one noticed the danger lurking beneath the surface of their rapid expansion. The company continued to grow, and the new funds fueled impressive projects. But slowly, subtle warning signs started to appear. Operational costs began to creep up, eating into their margins. Revenue growth, once explosive, started to slow down to a more modest pace, and most importantly, the monthly loan repayments became harder and harder to manage. Instead of acknowledging the risk and slowing down, the leadership chose to double down. They borrowed even more, hoping to outrun the problem. Then, the market shifted. The favorable conditions that made their debt strategy seem so clever suddenly vanished. Interest rates, which had been low for so long, began to rise sharply. Consumer demand dropped unexpectedly, and the company's once reliable cash flow dried up almost overnight. Suddenly, the massive loan payments they had taken on became impossible to meet. Investors, sensing disaster, panicked and started selling off their shares. The stock price, once a symbol of their success, crashed spectacularly. Within a few short months, the billion-dollar company was no longer focused on growth, it was fighting for its very survival. This story, while dramatic, is unfortunately not unique. Many promising companies fail, not because they have bad ideas or weak products, but because of poor financial management. Debt can be a powerful tool to accelerate growth and seize market opportunities. But unmanaged debt, especially when based on the assumption that good times will last forever, can become a poison that destroys everything from the inside out. This case teaches us a crucial lesson in business. Long-term survival is not just about how fast you can grow, but about how well you manage risk. If you want to learn from more real-world business stories and gain valuable financial lessons, make sure to subscribe to our channel, because in the world of finance and business, knowledge is, and always will be, your most valuable asset. Thanks for watching.